welcome. I'm Dan Rundy. I'm a Senior Vice President here at CSIS. I'm thrilled to be hosting my friend David Malpass. He's the President of the World Bank Group. David Malpass has been a fabulous steward of the World Bank Group in his tenure at the World Bank. He has done a number of really important things, including reaching new financing records, including the $150 billion response to COVID, $170 billion response to Russia's illegal invasion of Ukraine, $16 billion in disbursements to Ukraine, and launching the Pandemic Fund as well as the Climate Change Action Plan. David Malpass also presided over a historic $93 billion replenishment of something called the International Development Association, something better known to those of us in the business as IDA, which is the soft lending arm of the World Bank Group for the world's poorest countries. This is really a historic achievement. It's a thrill to have David Malpass, and he's going to make some introductory remarks, and then Mr. Malpass and I are going to have a conversation. So David, I'm turning the floor over to you.
Thank you very much, Dan, and thank you to CSIS for inviting me to speak on growth and private sector investment. So good afternoon, everyone. This event is timely. I'm going to speak about how the World Bank Group is strengthening our delivery of private capital facilitation, what I'll call PCF, private capital facilitation. These efforts are key to strengthening private sectors in developing countries, attracting private capital, and achieving faster growth. The PCF initiative will boost sustainable development that is inclusive and environmentally friendly, reduces carbon, enhances energy access, alleviates poverty, and achieves the required pace of global digitalization. Let me provide context, global macro context, and then outline our new and bold PCF initiative. The developing world is facing an extremely challenging outlook with growth slow and interest rates rising. I call it a crisis-facing development. Much of the world's available capital is being absorbed by a narrow group in the advanced economies to sustain massive national debts and central bank duration mismatches. I spoke on the deepening inequality at the G20 meetings in India last month. Living standards are diverging rather than converging. Restoring growth, including growth in median income, is critical to the World Bank's mission of poverty alleviation, shared prosperity, and sustainability. With interest rates rising to more normal levels after over a decade at near zero, I expect a long period of asset repricing and regulatory interventions. Last week's banking turmoil underscored the tendency of governments in the advanced economies to protect against losses. If so, this risks allocating much of the burden of losses to average taxpayers and poorer countries. The bond buying policies of central banks protected government bonds, mortgages, and municipal bonds, causing a reach for yield. Even before Silicon Valley Bank, the Fed already projected a huge ramp up of its bond purchases starting in 2026, protecting bond owners and issuers. Many other guarantees are already in place to protect those with the most assets. Japan has a cap on the 10-year bond yield. In effect, that puts a floor on the price of government and corporate debt. Governments often guarantee high returns on pensions. Investors in sovereign debt have seen their returns largely protected. The risk from this is less dynamism and more reliance on regulation. We should expect slower economic growth and a continued concentration of capital in the advanced economies. For many developing countries, this leaves a desperate shortage of funds for education, nutrition, healthcare, and debt service. We estimate that developing countries will need $2.4 trillion per year for the next 7 years just to address climate costs, costs, conflict, and pandemics alone. This is a huge number and far above where we are today. It leaves infrastructure severely underfunded. Rather than growing, we expect the capital stock in 20% of emerging markets and developing economies to decrease between 2021 and 2024. Some estimates even show a decline in almost all emerging markets and developing economies at a time when massive growth in investment is actually needed. Private capital is essential to closing this financing gap. So I want to discuss that in the remainder of my remarks. Enabling private sector investment and capital flows are core activities and a priority of the World Bank Group. PCF, that's private capital facilitation, features prominently in our evolution process on two levels. I just met with the full board this morning. First, we provide policy advice and lending that support economy-wide and sector-specific reforms and the preparation needed to unlock private capital through what we call private capital enabling. Second, we channel capital to World Bank Group operations through co-financing from private investors through private capital mobilization. Those two, PCM and PCE, work together as we help create well-regulated and competitive markets that attract private investment. You have to have an enabling climate and you have to bring in capital inflows. Let me walk you through the three main pillars of our new approach and how they address the key challenges. Our aspiration over time from these three pillars is to see the creation of a massive, dynamic, investable asset class for infrastructure in developing countries that spans borders and sectors in order to diversify risk and achieve lower financing costs. The first pillar is enabling private capital by creating a conducive environment for private capital to flow. Helping countries achieve macroeconomic stability and promoting prudent monetary, exchange rate, and fiscal policies are at the center of the World Bank's economic policy dialogue with client countries, and they are important aspects of business enabling. Also, we have been making efforts to increase transparency of public debt contracts to better assess debt sustainability and promote accountability. To guide this work, we are also revamping core analytics that will more systematically identify barriers to private investment and capital market development, as well as market distortions that affect capital allocations. The product of these analytics will focus on actions that countries need to take for a sound investment climate, for competitive markets, and for a balanced role of the state in the economy. These analytics will complement our toolkit targeting private sector development. That includes IFC's 3.0 strategy for creating markets with upstream work, and it also complements the new business enabling environment reports. Those BEE reports will evaluate the business environment both from the perspective of an individual firm's ease of doing business and also from the standpoint of private sector development as a whole. We can then take the knowledge from these analytics to create multi-year programmatic engagements that support targeted reforms and create prioritized opportunities for the private sector in core areas of focus, as well as new areas such as agriculture, digital, and housing. We will also continue to be a key contributor to the development of international standards, including on sustainability and transparency, so that the regulations are proportional and don't unfairly burden developing countries. The second pillar is building capital in investment pipelines that address the often mentioned challenge that there are not enough projects in developing markets that can attract financing. We aim to establish World Bank Group global priority programs that will develop initial projects and follow-on transactions that will combine World Bank, IFC, and MEGA interventions and then replicate these in different cities and countries. This work is designed designed to create robust capital investment pipelines of viable projects by identifying, framing, preparing, and assessing the feasibility of projects in a variety of key sectors. For example, these programs could focus on energy access, the digital economy, or access to capital for entrepreneurs in Africa. Delivering growth and impact requires investment approaches designed to realize scale and uniform documentation. As examples, our scaling solar and mini grid portfolios are two successes in realizing the efficiencies and impact of scale and uniformity of contract. In addition, our work on quality infrastructure investment, work that's been ongoing for nearly a decade now, or QII, is also helping to increase private investment opportunities. One important example is our partnership on QII with Japan, which has helped mainstream the QII principles, quality infrastructure investment, in more than $22 billion of World Bank projects. We also house the Global Infrastructure Facility and the Public-Private Infrastructure Advisory Facility. Those help us build pipelines of impactful, high-quality, and resilient infrastructure. As part of this second pillar, we are also looking to create new opportunities to support SOEs, to attract private capital. State-owned enterprises in the world's poorest countries are large economic actors with revenues close to 16% of GDP and employment accounting for around 6% of formal sector employment. This work helps SOE utilities clean up their balance sheets and use transactions to expand their debt capacity and optionality. It also helps reduce debt service costs and operating expenses and enhance credit ratings. Underlying all of this is the desire and the need to get more investment and more growth in developing countries. Our work in this area supports reforms on regulatory frameworks, competitive neutrality, pricing, tariffs, and governance to improve the fundamental dynamics. We support SOEs, state-owned enterprises, to optimize their balance sheets and their operational efficiency, also to monetize existing assets so that they can make new investments for growth. That's called asset recycling. In addition, our technical and financial support helps sovereigns, subnationals, and private sector clients access sustainability, green, and blue debt capital markets. And finally, we are exploring support for hybrid public-private partnerships where World Bank financing or guarantees can help ensure a balanced risk allocation and make the PPP feasible. This vertical is critical because it is designed to strengthen the backbone of private finance solutions in emerging markets. SOE utilities, that's electricity, water, and other utilities, represent the largest pool of energy and infrastructure projects of scale in the emerging markets. As such, healthier SOE utilities that can stand on their own for credit purposes present less project risk and therefore will promote greater project velocity at lower risk premiums and make a meaningful impact in creating robust project pipelines. We need those. The final pillar, the third pillar, and then I'll conclude, Dan, the final pillar is establishing private capital connectors by creating a market of investment-grade securities that will provide institutional investors better access to emerging market and developing economy infrastructure debt. This work aims to create greater depth and liquidity and longer tenors in emerging market developing economy infrastructure debt markets, mainly domestic capital markets. It does this by aggregating and packaging MD loan assets, EMDE loan assets, into investable securities for institutional investment. The IFC's highly successful managed co-lending portfolio platform, that's MCPP, and it already exists and is operating. It's an excellent example of significantly scaling up IFC's debt mobilization mobilization from institutional investors. And indeed, we are exploring an originate to distribute model to unlock institutional capital at an even greater scale. For example, IFC is developing a new multi-billion-dollar platform to securitize IFC loans by packaging and distributing them to institutional investors through a warehouse. This platform can also be designed to include assets originated by other MDBs and possibly in the future tap into the market of EMDE infrastructure loan assets originated by commercial banks. The bank is also exploring a co-financing facility that would be supported by grants and first loss guarantees by donors and would co-invest in projects prepared and financed by the bank. These debt aggregation vehicles require market reforms for optimal impact. Thus, we will focus on reforms to develop local capital markets with legal and regulatory framework for securities issuance, investment, trading, and supervision. We also support incentivizing deeper pools of domestic savings for investment with fuller financial participation by lower income households and women. The World Bank Group Joint Capital Market Program, we call it JCAP, will strengthen its efforts to provide both advisory and financial support. Finally, giving investors high-quality data is key to help them properly evaluate projects. We are working to enhance investors' access to payment history for private sector projects in developing markets through GEMS, the Global Emerging Markets Risk Database. Currently, the data is only available to the consortium members that contribute data, mainly MDBs and development finance institutions, so it's underutilized. Making the aggregated statistics available to investors would be a global public good, and we are working on ways to do so with appropriate safeguards and quality standards. Progress on all three of these pillars is heavily reliant on blended finance approaches from the global community, where concessional resources are combined with commercial funds. Blended finance solutions optimize risk sharing by the private sector and avoid socializing losses and privatizing profits. As an example, we introduced our new fund called SCALE, which stands for Scaling Climate Action by Lowering Emissions. It can be a major channel to provide blended finance in middle-income countries to fund verifiable emissions reduction and help countries build a track record of projects that can lead to unlocking private capital through carbon markets. Verification is key to building trust. We also issued outcome bonds, a water bond, this is last week or in the last 2 weeks, a water bond in Vietnam to provide clean drinking water to school children. We last year issued a bond called the Rhino Bond in South Africa to conserve the highly endangered black rhinos, where in that bond, payments to investors depend on verifiable outcomes, increases in the black rhino population. You may have seen my description of these two innovative financing techniques in Barron's over the weekend. Results-based approaches such as scale and outcome bonds, the Rhino Bond, the Vietnam Water Bond, are transparent and they avoid greenwashing. The three pillars, I'll name them: enabling private capital, building capital investment pipelines, and establishing private capital connectors, provide the blueprint to massively increasing the amount of private capital flowing into developing countries. This programming will be delivered on a one World Bank Group basis. It benefits from the World Bank Group's partnerships with recipient governments and private investors and development partners, and also with donors. From the World Bank Group's analytical and diagnostic work that brings focus to geographic and sector priorities, and from our expertise in realizing economies and efficiencies of programming based on scale and uniformity of structure, documentation, and approach. Each of these parts is critical, hasn't been happening, and the capital flows to developing countries are going down, not up. So the change and the new approach is necessary and needs to be pushed by all partners. This program requires a high degree of partnership among all key stakeholders. It helps to meet climate and development objectives through private capital enabling and mobilization. It maps a holistic, practical, transactional, targeted, and efficient approach for all partners. And perhaps most importantly, it's ready now to help millions of people all over the globe. The World Bank Group is uniquely positioned to play a leadership role in this game plan. Of equal importance are the roles and responsibilities of all key stakeholders: donors, recipient governments, other IFIs, the IMF, other MDBs, institutional investors, and other private sector players, and importantly, the rewards that successful partnership will bring. Chief among these rewards is the World Bank's ability, alongside all of its great partners in the global community, to facilitate much greater amounts of private capital for impactful and scalable projects for sustainable development. Thank you.
David, thank you very much. I remember an important study by the World Bank about 15 years ago that looked at the size of the private sector in developing countries, and 9 out of 10 jobs in the developing world is in the private sector. If you want to finance education, you want to finance health, you want to build roads, you want to build power, you want to have police on the streets, you got to raise taxes, and that comes from the formal private sector. So I think it's very sobering, the statistics you were just describing, because we have I don't know how much, we maybe have $150 billion in foreign aid globally, maybe it's $200 billion.
Yeah, I think that's stretching.
That's with would say in Argentina, with a whiskey in hand, maybe it's $200 billion. So I just think, you're talking about trillions of dollars that are needed. And so what you're saying is we have, just like the Sustainable Development Goals have talked about this, our goals on climate, all have talked about we need to crowd in the private sector. So what you're talking about is what can the bank group do through its research, through its guarantees, through its investment products, through its expertise, through its as a trusted convener and partner. What are all the things that it can do to help crowd in the private sector at this moment, right?
That's right, and it's also dependent on the countries and the regions, groups of countries, taking steps that really are attractive to the private sector itself. So the starting point is their own businesses. How do you get businesses in developing countries and people that do have money in those countries to put them back into the country? So that's a list of steps that the countries can do that we call that private capital enabling. And some of that is capital markets. How do you create markets where foreign investors want to come in, or, and very importantly in this, locals who have their money abroad, which is
a lot of countries are like that.
Capital is outside their own country. Remittances are a big flow. How do you get remittances to want to come into businesses in countries? A lot of the remittances right now just go to families. They're sustaining their consumption. We need that, but we also need them, people with some amount of money, to start a new business, and they need the climate that can do it. So. And the World Bank has been kind of separating the private sector from the government sector, and we really need to see it's a holistic or one world approach. The government has to want to help the private sectors grow.
Right. So I think that's right. I think we have to. So I think if I think about the World Bank, it's had the IFC dealt with the private sector. MIGA sort of dealt with the private sector, and the IBRD and IDA, which is the fancy term for what we call the World Bank, dealt with the public sector, right? And national governments. And what you're saying in your remarks is all those pieces of the World Bank need to operate as one to crowd in the private sector, because there just ain't enough foreign aid. How much did you all lend last year at the World Bank Group? As
much as $100 billion. That includes all the things you named IBRD, IDA, IFC, and MIGA.
So there ain't enough. That's a lot of money, and it was historic for the World Bank, but it's not enough. It's not $2 trillion, and it ain't going to be $2 trillion, right?
That's right.
Okay. So I want to talk about a couple.
And within just one point in this approach, and it gets people's eyes glaze over, but We do a lot of diagnostics on private sectors in countries, but it's not wedded closely enough to the programs that we actually do.
So you do these analytics, and then you need the country director at the bank to take the analytics and walk it over to the finance ministry and say, look at these important analytics, and say, hey, you really need to make these fixes. Now, the bank group is underestimated in many parts of the world of how important it is as an influencer. So the money's really important, but your advice, you're a trusted advisor and expert, that's really important, right? So what you're trying to do is merging those together, right?
Okay. So at the same time we're talking about how to help agriculture and farmers, we want to help the private sector channels that helps those farmers. So how does the fertilizer come in, and what's blocking the fertilizer, and so on down the whole range of activities. Tractors is actually a big important topic. They're not being financed because there's obstacles within the country's climate, their environment.
So I want to talk about two things that are going to feel like inside baseball for listeners who don't follow the World Bank, but are one is a hobby horse of mine, David, and we've talked about this before. I really think the analytics that you do on business enabling environment work is really, really important. So I'm really happy to hear that there's going to be sort of some future looking business enabling environment work. Could you just spend one more minute about what that's going to look like?
Yes.
And you know where I'm going with that.
It is important. So we had a report called Doing Business, but it operated with a smaller group. It was asking the firms, big firms within countries, what could be done, and not really getting to a survey approach. So it's going to be unveiled and with a lot of work to actually look into countries and say what are the identifiable changes that are blocking new business formation and growth.
When will that come out, David?
So it is being discussed.
It's being
with the
cooked
board
right now, right?
Well, the surveys have already started, so we're commissioning the surveys. There's a lot of budget behind it in order to really support this whole effort that I'm talking about here. You have to have the analytics on the climate. You also have the analytics that IFC has been doing. You put the two together and you get country programs and regional programs. I mean, some of these items will apply broadly. So you can say all across West Africa there's this problem, and we can address it with laws that are changed or with conferences that get at the problem. A lot of it is going to be actually ways that capital markets can work across borders to bring capital. You know, the principal concept of capital is risk diversification. So if you're a wealthy person in one country, you don't want all your assets in that country just because it's you want to diversify.
Sure.
So if there's a method to do that across borders, all of a sudden the investments are worth more. I'm willing to put much more money in if I get 2 countries within my portfolio,
sure,
or 5. So getting the countries to work together or to simplify. I mentioned over and over again the idea of documentation being standardized. So one of the things is to have contracts where people in different spots can read and understand the contract. Yeah. Laws are so different in parts of the world, it makes it very hard for an investor to invest in 2 different
You
places.
want apples to apples.
Yeah, apples to apples.
Okay, so David, the other thing you mentioned in your remarks I was very interested in was the idea of securitizing World Bank Group debt and selling them to institutional investors. That's a significant, that's very interesting.
Now that's a little different issue, and that is also being discussed in our evolution conversations with the board. I was mentioning something a little different. Right now, there is a large amount of assets in the world that are owned by state-owned enterprises that aren't very well run. So the asset is underutilized this is in developing countries. And so the goal is to allow some kind of a process for those assets to be sold to investors. Ideally, if they can be packaged, securitized, and sold to investors on a standardized basis. If you think of the mortgage-backed market in the
That's
U.S.,
what I was thinking.
There needed to be some commonality of terms, and then once that was done, if you can put multiple ones together, it's more attractive to investors. Shouldn't that be done with infrastructure? So let's say toll roads. Let's say one country actually enables toll road investors to come in, and you all of a sudden have roads that are maintained, that are used more actively, that really transport freight because the trucks are paying for maintenance of the road. Think how much more it's worth to investors if there's 3 countries or if there's 10 projects within a portfolio of assets. That's just an example, and then there are many more. I also mentioned in the speech the idea that commercial banks are, one big source of this is commercial banks in developing countries. They take deposits from people in developing countries. They make loans to businesses, and then it gets stuck. It's not very saleable, and so if there can be a package, I mean, that would be
an ultimate
goal. It's much bigger. We're talking 10 times, maybe 30 times as much total assets that would be saleable to investors around the world that would help growth in the developing countries.
It's very exciting. Okay, so David, there's been lots of discussion about global public goods. So some global public goods are things like data. So things like the analytics that you all do. I would consider the doing business indicators to have been a form of a global public good. And then I think there's other global public goods that are often talked about. Climate is one as well. It seems as if there's, how does the global public goods conversation intersect with the agenda that you just laid out?
It's important because, for one, it needs a lot of inflow. If you think about, you named one, which is data. Data is expensive, so if you, and yet it has huge value to big groups of people, not just in one country, but multiple countries. But that's true of the adaptation, for example. Yes, it's valuable to people in one country, but it also means that there's less disaster that affects other parts of the world. It also helps on the migration side. And this, you can go on and on with this discussion, recognizing that people are living in the same areas and facing similar problems, and so we can't just treat it on a one country at a time basis. But that then immediately gets you to thinking about how do you have common funding for things that benefit everyone. Within our World Bank evolution discussion that's been going on now for 3 months, and pretty intensively with the executive directors and the capitals, people talk openly about which are the most important things to be funding on a global basis. Even in our discussion today, there was the point that agriculture systems are, in a way, in a full way, are a global public good because they allow food to be grown in an efficient way around the world. So shouldn't there be support for that from the global community to help people, not just in their own country, but in groups of countries. Fair enough.
So, David, you've been the president of the World Bank Group and a really great steward in a really tumultuous time. We spent a year of our lives in our basements during COVID. We had Russia's illegal invasion of Ukraine and all the spillover effects of food and fuel that's negatively impacted poor countries. You oversaw a historic fundraising for IDA over the last 4 years. Two of those. Yeah. So you've really, been a great steward of, and I think what you've laid out is really important because there ain't enough foreign aid, there ain't enough World Bank money, there ain't going to be enough foreign aid money to meet all the climate goals, all the development goals, all the infrastructure goals. And so what I think you've put on the table is really, really important. You've announced you're leaving, and there will be a successor at some point. So do you have any advice for the incoming successor you want to give?
I don't know about advice. So the challenges are clear, and I'm hoping to make it a really smooth transition. So we're completing a lot of things right now. It's been a very busy time for the bank, and for me, we are trying to wrap up as many things as we can, and then set the stage. Because, as I laid out at the beginning of these remarks, the world is a really difficult place right now for people in developing countries.
There's going to be some rough sledding.
Interest rates going up, as we saw yesterday in the U.S., but last week in Europe, rough sledding. And one of the things I'm focused on, right now there's just not enough capital that's available for investment into the developing world. We have this bad situation where a huge amount of the world's capital is going to countries where the population is going down and the labor force is really going down. So you're pumping more and more capital into declining populations when elsewhere in the world there are rising populations.
Africa, Pakistan.
It's in various parts of the world.
Guatemala.
Yeah, all with high birth rates, but also with big potential for the future of the world. If you think of a key global public good, it's educated children. If they can read
100%.
and do numbers, they're a global public good because they will be getting jobs and producing things. That's what the whole world wants. And so don't we need more money going into education that actually works?
I love that. I mean, if I think about the East Asian miracle, that was about a demographic dividend as opposed to a demographic nightmare, right? And so we had a growing population with a youth bulge, but they invested in young people, and we had this transformation in Asia. I am hopeful that we will see that in Africa. There will be more Africans than there will be citizens of India and mainland China in 25 years. So if we do the sorts of things, invest in people like you're describing, we would have a demographic dividend in Africa.
Exactly right. You know, we've done a lot of work on education and the losses that occurred during COVID because of largely the school closures, but we're really struggling to recover those losses. So we've put a high focus on certain steps. One is to have kids in school. The correlations show that the best indicator is how many hours are the kids in school. So if you can get that up, and the difficulty is, especially for girls, they're not in school that many days and that many hours per day. So you need to do that. You need some more funding, though that turns out not to be the single issue. You need to teach foundational skills. One of the missing links in education is kids are spending hours in the day, but that it's not enough on foundational skills. So, and the literacy rates are not nearly high enough. In fact, our data shows that some 70% of kids at age 10 in developing countries can't read a basic text in their native language. And so that's a big problem. So we need all those, and we also need, one of the things that comes out of the research is to teach kids at the level they're at now. If they've gone backward 2 years because of out of school, then you can't put them in the higher grade, the grade that their age would justify, because then they're lost and they're very frustrated. So there needs to be enough flexibility within the education system to teach kids at their level.
So I want to thank you publicly for your public service at the bank group. You've been a great steward. I'm really grateful to your service, for your service. I think you painted this is a moment of a lot of rough sledding. I'm generally an optimist. Could you leave us with something you're optimistic about?
I'll put on one more, not optimistic, and then
okay,
turn
thanks.
to optimism.
Thanks,
not
right.
optimistic is the problem. If you think about the resources needed for the countries, the two biggest, so it'd be great if there was enough development assistance to just fund developing countries. There's not.
And there's not going to be.
There's not going to be. So we have to turn to two other critical sources. One is this debt restructuring that I've advocated.
You've been working really hard on that.
The countries entered into contracts that they shouldn't have done, and there's no way out right now. And so as interest rates go up, the countries are stuck. So we need to have breakthroughs on that. I've written a lot about that. And the other big source is what we just talked about, private capital enabling. So allow people to invest in their own countries or in foreign countries that they perceive have opportunities. So those have to be the new flows that we really concentrate on. Now, as far as then how to be constructive on it, I will say one thing. You know, technology is moving so fast that those countries that can grab onto it really do attract. We've seen in Senegal, for example, the digitalization allowed this overnight transformation of the payment system because there was a breakthrough of a monopoly. There'd been a monopoly that blocked progress. They broke through the monopoly. World Bank, IFC was very engaged, and that has transformed. So people can do small transactions without fees, which is huge. It enables poorer people, women who have never been in a business, all of a sudden they're able to transact, and that's empowering. So, we could go on with that technology across the area. In the energy sector, there's huge new technology that might get people electricity, because we still have 800 million people who don't have electricity, and therefore they don't have cell phones or information flow.
So you're a guarded tech optimist.
Yes.
Okay.
Not even guarded. Massive.
You're a massive tech optimist.
It can change the world.
Thanks for doing this. Come back. Thanks for your service. This was great.
Thanks, Dan.
David.
Thank you, CSIS.
Thank you. Thank you. Thanks. Okay. Thanks. I'll be in touch. Thanks. We're back. I'm Dan Rundy. I'm Senior Vice President here at CSIS. We just had President David Malpass give some remarks, and then I had a conversation with him about the future of global development, especially with a focus on crowding in the private sector, because his message is we're going to be in for a period of significant rough sledding in the emerging markets. There's significant amounts of foreign assistance and official development assistance, but that is not going to be enough to meet all the challenges that we face in climate and infrastructure and development, and we're going to need to crowd in the private sector. And then he discussed at length in his remarks the various ways in which the bank group is going to be working in a much more joined up way to crowd in the private sector, both through analytics and guarantees and other instruments, as well as their advice. So we're going to talk about the world that we find ourselves in with three very distinguished panelists. I'm really happy to have Mr. Malpass's Chief of Staff, Mr. Sam Maibo. Thank you, Sam, for being here. My friend Jeffrey Okamoto, who's a Managing Director at Goldman Sachs and a former Deputy Assistant Secretary of the Treasury. Thanks, Jeffrey, for being here. I'm really happy to have my friend DJ Nordquist, who was the former U.S. Executive Director at the World Bank Group and a Senior Advisor here at CSIS. So thanks for being here, DJ. So we're in for a challenging, this is a challenging time. There's an important role for the bank group in all of this, but we also have to make some choices. Let me start with you, Jeffrey, because I think we've talked about this before. You're an important thought leader on the issue of, David Malpass talked about the debt. He referenced it at length. It seems to me that there's some macroeconomic challenges, but there's also this elephant in the room, which is this debt crisis in emerging markets that is also impacting kind of the conversation that we're going to be having in terms of alleviating poverty or confronting other challenges such as climate change.
Yeah, no, thanks, Dan, and it's great to be here to discuss these important issues, and maybe just a little bit on David himself, right?
Yep.
I mean, because I think it links to the debt issue,
Yep.
right? He's been a huge champion on debt, and why is that? Because if you think about David's background, which is quite unique among World Bank presidents, right? Deep expertise in macroeconomics and finance, and a passion for development, going back to, we shared the same job at the Treasury Department, him in the 1980s and me a few years ago. So think about that blend of expertise, right? And a big feature of what he's focused on as president is the debt agenda, perhaps the biggest voice on that that we have. And it's because it blends all those issues, right? The macroeconomics, the current financial conditions, and the current state of development. And you think about where we're at, we haven't really gotten to the core of this issue yet. And now it's, for David's remarks on the enabling environment, part of the enabling environment, in my view, is the debt overhang that exists in countries that wards off private investment from coming in and making the investments that are required to really help close the growth gap and return a country to convergence. What we do about that, I think, is subject to a lot of debate. But now I think reframing this not as a developing country challenge, right, or as a debt challenge per se, but as a development problem and a growth problem and an investment hurdle, right, is probably a way to put some more momentum into that debate.
Do we need to have some sort of political agreement among powers such as the United States and China to get at this issue of debt?
I think you need all creditors, right, right, public, private, to come in and tackle this, and not easy, right? I mean, all assets are repricing, right? So the credits that were made to these countries are priced differently today than they were a few years ago, and so there needs to be some recognition as we're seeing that reckoning happen across global markets and across the financial sector. That has to happen here as well. And clearly the COVID shock and the energy shock and the food price shock may have crimped, right, some countries' ability to service debts that were otherwise deemed sustainable even just a few years ago. So I think a fresh look at this issue is required, and then you can start thinking about what more do we have to do collectively to tackle this problem. Okay.
So DJ, thanks for being here. Sure. You were executive director when David Malpass was president, and you've since followed the World Bank Group closely. I welcome your thoughts. Thanks for being here.
Sure. Well, I think sort of the overarching theme of the talk was sort of the future of the World Bank. So I just wanted to briefly talk about, sort of where the bank has been and where it is today, which is obviously, this is a Bretton Woods, institution, which was created by the U.S. and the U.K. after World War II to help, countries basically rebuild after World War II and to stabilize the international, financial community. And Jeffrey also was the number 2 at the IMF. But the world, I don't think that back in the day that the folks who sat down and created these institutions ever really imagined that there would be a non-market authoritarian economy that was so big and has become so important on the global stage and at the bank. And so I think you're seeing this bifurcation at the World Bank, at other institutions where you have those non-market authoritarian economies and their satellites, on one side, and then you have sort of the democratic capitalists on the other. And so I think there is, attention, and you were talking about, debt. David was fantastic with the debt service suspension initiative during COVID, and there was a push by the United States and the G7 to have debt transparency and to get most of these developing world countries basically to cough up the data on how much debt they had and where it was from, and not surprisingly, it was from China. And I think one of the interesting things was when China was pushed to try to either forgive or increase the tenor on those loans, they claimed that the China Development Bank was not a development bank. It's in the name. So they tried to sort of not be a part of that system. So generally speaking, I think there is this this tension that there is political economy at the bank. Like there is lots of organizations like that. So I think China is an issue at the bank. I think there's been a discussion about the evolution roadmap. I think the bank does need reforms. One reform that I would add to the list is mandatory graduation for countries. Graduation meaning that you no longer take World Bank loans. China takes over $1 billion a year in IBRD funding. They get, I think, somewhere between 600 and 800 million in IFC funding. At the same time that they're taking money from the bank, they're also lending it out on the back end and creating this unsustainable debt. So I would say that there needs to be a mandatory requirement. There are 3 very good criteria that the OECD came up with for what a country should have to graduate, and China has met all those requirements. And I think that money would be better served not in the world's largest economy on a PPP basis, but in the Southern Cone.
This is the best thing I've heard all day. I 100% agree with you, DJ. That's great. Amen. Amen to that. So, Sam, thanks for being here. You're the Chief of Staff to David Malpass. How long have you been at the World Bank Group?
22 years.
A long time.
Long time.
So you've seen a lot of changes in the bank group. There's been a discussion here about some potential evolution by the President David Malpass and in discussions with the board. How is obviously the World Bank Group plays a really important role in confronting all sorts of challenges, the food and fuel crisis, responding to COVID. There's been this historic capital increase. Sorry, this important fundraising for IDA, which is the soft loans for the world's poorest countries. There's been some progress made on these debt issues, and the World Bank's played a role in that. Where at the same time, I get the sense, and I worry that there's a push for confronting a variety of really important and pressing global public goods. And then there's also a traditional mission for the World Bank Group, which is around poverty alleviation and job creation as well. Is there enough money for the World Bank to do all these things? And how are we going to square that circle, Sam?
How many hours do we have?
No, I've got time. It's a think tank.
Well, first of all, thank you for inviting me to join you here, because this is an illustrious group, and I've been incredibly impressed by the work that Jeff and DJ have done at the bank. I think following on David's remarks, stressing the new direction for the need for private capital, I think it's important that we don't lose focus on why we're having this conversation. And I have 3 words that I would run with. The urgency of the crisis. I mean, if you look at this problem from a developing country perspective, all of a sudden you're seeing your poverty numbers increase. You're seeing your levels of income stagnate. So just there taking it back to the mission of the bank, we're already losing on poverty and shared prosperity. But from a developing country perspective, what worries me even greater is the losses that we are seeing in education, in health, all of the long-term development activities that really matter for a country that wants to address some of its challenges. So by the time you tag on your excellent point about debt, then you know for sure that your private sector is being crowded out every single day. As we have confronted the debt crisis, a lot of countries are now turning to their domestic banks for financing. That's pushing up the pricing of private equity. So even as we address this issue of bringing in private capital to sustain the growth, developing countries are stuck because there is not on the horizon any prospects of growth that you can point to immediately. So we're left with a challenge of doubling down on two sources of financing. One, public financing, and as we all know, the US, the UK, and others have been exceedingly generous. But those finances are limited.
You know, there's a ceiling.
There's a ceiling there. And then, of course, we can double down on private sector. And it's a tough environment there, because at the same time, even as we talk about all of these pillars, we've got to remember that if you're a private firm, you're likely going to look into those markets that have good environments. So if for a continent like Africa, we're seeing a concentration of capital into the Nairobis and Kenyas of this world, you're leaving out the Malawis, the Zimbabwe's of this world, the Zambias of this world who are highly debt distressed. So as we have this conversation, let me just really stress the urgency of the crisis. If you're a Minister of Finance in any developing country today, you are super pressed. Secondly, the scale, the magnitude is significant. And really, all of the fact that we have these multiple crises taking place at the same time is really challenging the fundamental pillars and strategies we've had for development. And that's why we need think tanks like yours to come up with new ways in which we can very quickly address some of the pressing challenges we have.
So let me ask each of you, I'm really grateful for David's very important public service and really, I think, really impactful public service as president of the World Bank Group these last 4 years. Can I ask each of you to think about what advice you'd each give to the incoming president of the World Bank Group? And let me start with you, DJ.
Wow. Well, I'd say, carry on. What David has done. I mean, particularly the debt sustainability, which we just discussed, is super important. I would say my prior point, which is to institute a mandatory graduation from the World Bank. Graduation, I used to give these speeches at the board all the time. It's a club you want to be in. You should aspire to graduate. There are countries that have graduated and have done great.
You want to join the OECD. When you grow up,
Right.
You want to become a member
Exactly.
of the OECD.
Right. And by the way, if you fall on hard times, like what happened in COVID, there were a number of Caribbean countries that had graduated and they came back in, and we let them come back in because,
Because it was an emergency.
it was an emergency. We want to make it so that you're not afraid to graduate, that it's okay to graduate. So I would do that. I think it's interesting. There's been a theme here where we've talked a lot about education and human capital. I think that is important. I think that's one of the main goals of the bank. And we talked about sort of scarcity of public resources. So, I would say focus on what a development bank should be doing, and focus on, the system of putting the clients first. It's supposed to be a bottom-up system where the clients, come up to the bank and say, this is what we want to work on. I'll give a little plug for this great article that the Breakthrough Institute put out, where they actually analyzed what clients, the sovereigns want from the bank. And education was number one, followed by public sector reforms and jobs. So I think the bank needs to focus on that. And then I would also say, in terms of the climate agenda, to get to net zero, if you actually do the math, it's going to be basically impossible to do without nuclear. And saying the word nuclear at the bank is like saying Voldemort. I really think that the bank needs to rethink that strategy if climate change is the goal.
Amen.
And particularly because the bank is not doing anything in finance, co-finance.
Yeah.
There are lots of new technologies out there that are a lot less expensive. So
Yeah.
because the bank isn't doing it, the authoritarian non-market economies are. And I don't think that that's better.
DJ, you're a truth teller. Thank you so much. You've made my day. I 100% agree with you. The other thing I would just say is, if you are concerned about climate and you're not enthusiastic about mining and minerals to the tips of your toes, the whole conversation about climate is baloney. Or malarkey, I think is the term we use here in DC. It's a malarkey conversation. So, but I used to work at AID, I worked at the World Bank Group, I've done a lot with DFIs. The idea of working with mining, most folks would rather get a root canal than talk about mining and minerals. Decarbonization, if it's going to happen, doesn't mean dematerialization. So we got to learn to love mining and minerals in a big
it's
way.
Basically swapping out a fossil-dependent economy for a mineral-dependent
Right.
economy, and
So
it's they're obviously
Right.
trade-offs.
One of them is that 40% of the metals processing right now is controlled by China. So we're going to switch from Iran, Saudi
I think
Arabia.
it's more than that.
Yeah, Iran, Saudi Arabia, and Venezuela for mainland China. I'm not sure that's a super exciting
and child
story.
labor, where they're
Yeah, and
digging up
child
the
labor,
minerals in
right.
Africa, unfortunately.
So I'm just saying that if we're going to have all these things, so I 100% agree with you. So nuclear, yes. Minerals, yes. Client-focused, yes. Amen. And focus on the things that the clients actually want. Jeffrey, so if you were giving advice to the incoming president of the World Bank Group, what would you tell him?
It's going to be a big job. But,
Yes, that's true.
I mean, just kind of picking up a little bit where David was at on this, and then kind of providing a bit of advice. The needs are growing, so the demands that the world is placing on these institutions, the World Bank and others, right, is
ADB
is growing, and the capital is becoming more expensive. So there's less grant coming through, and the capital market execution is becoming more expensive as the environment normalizes. And so I think where President Malpass is kind of taking the conversation on this is if you think about the enabling environment for the private sector, which is, you point out, is a critical source of resources for this. You can't influence maybe the absolute price or attractiveness of these, but you can influence the relative cost, and you can influence the relative attractiveness. And I think David didn't say it, but knowing him for a while, right? I think implicit in that is that there's some amount of competition you're going to foster between countries themselves to reform a little faster, be a little bit more attractive, right? And then those that can do it just a little better than the others can receive the resources they need to go. And in that kind of system, the capital is going to reward the areas that can actually grow the fastest. I think that's a healthy dynamic. And if you think about where this evolution has been, and Dan, you've tracked this area longer than I have, we had IFC, old IFC.
Old IFC.
Then we have billions to trillions.
Yep.
Okay, then we have Cascade approach.
Cascade.
Then we had private sector diagnostics, which we talked about. IFC 3.0.
It was 2.0. I was there for 2.0.
Okay.
I have an umbrella, 2.0.
But we're kind of getting this place where the IBRD and IDA need to help do the policy lift, right? And it probably shouldn't just be, in my view, the advice I give is probably shouldn't just be the World Bank, right? You probably need to bring the IMF in on this and make sure they are linked at the hip in getting these reforms locked in. It probably requires major bilateral partners of the country to make sure they're rowing in the same direction as well. And the last bit of advice I'll probably give is, you read a lot of the commentary on this, and I'm half a step out of this world at this point, but resources are becoming scarcer, and I'm not too convinced that more financial engineering or alchemy is going to deliver a massive new bucket of resources, right? So in effect, the time that we had as rates got lower and lower was used for exactly that. A lot of the innovation, either in the instrument side or on the balance sheet itself, geared in that direction. And so there may be some marginal amount of resource left to tap there. But in my view, right, I mean, and I think, who may likely be the incoming president of the World Bank is going to be well equipped to deal with this, given his background in business, is to really focus on the operational efficiency and not so much focused on the financial efficiency of the institution, because that, at the margin, as any other institution is now experiencing, can deliver meaningful resources over the medium term.
So Sam, let me give you the last word. Thanks for being here. So you're the current chief of staff of the current president of the World Bank Group. You've been at the institution for 22 years. What advice as a senior staffer at the World Bank Group would you give to whoever the new incoming president of the World Bank Group is, given the conversation we just had?
Don't do it.
Don't do it.
But
Don't do it.
Seriously, we live in a highly complex environment. I think the strongest advice I would give the incoming is, look, the World Bank is not perfect. And so embrace the evolution discussion, embrace all of the improvements that have taken place over time, whether it's Cascade 2.0, 3.0. That is a natural part of the process of development. There is no linear path to development. It's messy. And so accept that criticism as things that you should build on. And I think David has done that during his tenure. I would encourage him to really use the three biggest assets of the bank. The analytics. When I think about the climate diagnostics that have just been produced, all 12 of them, I think we'll be doing 20 very soon, enable the bank to have a larger impact than its balance sheet will ever have. And that's important because, as Jeff rightly pointed out, sure, we can increase our financing. I mean, over the last 7 years, we've increased our health investments from something like 3 billion to 11 billion. We've increased our investments on climate from 12 to 32 billion.
You're the largest financier of climate in the world, is that right?
Absolutely.
Okay.
The largest financier of climate. So you can go through every sector where the World Bank's balance sheet has been squeezed to its maximum. It doesn't change the fact that we're still nowhere near the types of resources we need. So as we use the analytics, as the incoming president continues to press our balance sheet and seek additional resources, I strongly would urge him to use the third pillar that we don't talk about much, which is the capacity building in country. If you really think about how the world has changed over time, my colleagues sitting in ministries of financing have the same access to technology and internet.
Just as we do.
The answers are there. It's the how. And which is why when David breaks down private sector facilitation into these three pillars, it is actually about investing into the specific building blocks at a capacity level. Think about that Ministry of Finance civil servant who has to deal with 13 applications for complex transactions he hasn't seen. I think of my sister who is a medical doctor with 100 patients that they have to deal with. It's not a lack of knowledge, it's a lack of capacity to be able to deliver. So my advice to the president, he'll ignore my first piece of advice, is simply, look, it's complex, but there's some great assets within the institution between the analytics, the capacity building, and the resources, and do the best you can because it's important in this complex environment.
Thank you all for doing this. I really appreciate it. Thank you so much.
very much.
Thank you.
Thank you.
Okay, thanks.